and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by George Boyd-Bowman, manager of the Neptune Global Income Fund. Hi, George.
Hi, Emma.
So I thought we'd start by taking a look at how the fund has performed. You had 3 stonking years of positive performance, and then year to date, the fund, much like equity markets, is down. Presumably the two things are correlated.
Yeah, sure. So, typically as an income fund, we do tend to perform better in stronger equity markets. That's been our house view at Neptune, and that's the way we've been positioned over the last couple of years. So therefore, the underperformance we've endured this year is in keeping with our expectations. Now, the key reason for that underperformance year to date is our positioning in Japan. As we know, Japan, after some strong years of outperformance against global markets, has endured a tougher period this year. Now, there are a couple of reasons for that. Firstly, what's going on in China. We know that just like we had at the end of last summer, China has induced another bout of global uncertainty and has had obvious implications for global markets. And there are 2 reasons why that affects Japan. Firstly, through end market exposure for Japanese companies, but also the impact of the yen. So we have seen some yen strength year to date as a result of uncertainty stemming from China, and that's meant that the Japanese market has struggled a bit this year.
Well, we should see the end of that yen strength now, shouldn't we? Because as of last week, Japan is now in negative interest rate territory, not across the board, but for certain bonds. And that will mean that the halt to the sort of yen rally, won't it?
Well, that's right. So it's not all bad news in Japan this year, I'm pleased to say. Mr. Kuroda, the governor of the Bank of Japan, has once again stepped up to the plate and helped out investors like ourselves who are positive on Japan. So as you say, they introduced negative rates, not on all of those balances, all of those deposits at the Bank of Japan, but on some of them. But once again, he's indicated that he is not finished yet in his mission to end deflation in Japan.
And the thing about Japan is, if we were sitting here talking to a global equity full-stop fund manager, I wouldn't be surprised to see Japan there. But for an income manager, I think Japan is a slightly different play, isn't it? Yeah,
and that's a really good point. So actually, Japan is our favourite developed market globally. And as you say, that's unusual perhaps for an income investor. And in fact, over the last 20 years, there's been no reason to look in Japan as an income investor. But that's changed. And that's changed because of Abenomics, and in particular because of the third arrow of structural reform. And what that's led on to is corporate governance reform. And that's led to this emerging dividend culture that didn't used to be there. And it comes down to these ideas of willingness and ability. So corporate governance reform in Japan is driving on this newfound willingness to be more shareholder friendly. And that's all down to these corporate governance reforms. Because in our view, there's no debate about whether Japanese companies have the ability to pay higher dividends. In fact, when we look at payout ratios globally, they're extremely low in Japan, just 30% versus 60% here in the UK. And of course, there are those massive cash piles on Japanese corporate balance sheets. To give you an idea of the numbers, if we look at just the largest 1,900 companies in Japan, that's all the companies in the Topix index, the cash on their balance sheets amounts to 80 trillion yen. That's $650 billion. If that was a country, it would be a country the same size as Switzerland. It would be the 21st biggest country in the world, just in cash, sitting there idle, doing nothing. In fact, if you include all companies in Japan, you can treble that number. So really, what gets us so excited about Japan is this new emerging dividend culture, and that's a combination of the long-standing ability of Japanese companies to pay dividends, but this newfound willingness, which is being driven on by corporate governance reform. And it's when you match up that ability to pay dividends and willingness that you create this really powerful, potent cocktail for dividend growth.
Of course, you're not just a Japan income fund, although obviously that you are very positive on the region. Another one of your sort of I think it's about 30%. 30% of the fund is actually in the US. Now, the US, if we were talking 6 months ago, everybody would have said, oh, it's extremely overflated. Why are you holding things a market that's so overvalued. Obviously, it's come off since then with all the concerns that we've had of China since the beginning of the year. Yeah. But a lot of people are still not positive on the US. What do you say to that?
Well, that's interesting, and you mentioned the valuation angle on the US, and we have a take on that as well. So one of the things we have been doing in our US holdings is rotating out of those so-called dividend aristocrats, those companies that have grown their dividends for perhaps 10, 25, even 50 years in a row, towards more what we call dividend special situations. So this is where they haven't necessarily grown their dividend consistently over the last 5, 10 years, but we think there's a reason, there's a catalyst why they are going to do so over the next 10 years. So instead of concentrating on the current dividend aristocrats, we're focusing on finding the future ones. And to do that, we use our dividend special situation framework. And that can manifest itself in a number of different ways. It can just be a company that's looking to raise its payout ratio over time. It could be a situation like Japan, we just talked about, newfound willingness, massive ability, or indeed, it could be a situation where a company is temporarily focusing on something other than growing the dividend. They might be focusing on reinvesting in the business, but once they finish doing that, they can focus on growing the dividend again. So, you mentioned the US. We are positive on the US. We actually think the underlying growth is strong. We think the housing market's strong. We think employment is strong. In fact, now expectations for interest rate rises in the US have fallen to, perhaps 1 this year. At Neptune, we're more positive. We believe, we should at least see 2.
But not the 4 to 6 we were predicting 6 weeks ago.
Perhaps not the 4, and of course, the Fed is still guiding to 4. I think that is unrealistic at this point in time, but it does have an implication for what type of companies you should own. Don't just focus on those overinflated dividend aristocrats. Safety. We feel you're paying too much for safety in those types of companies.
George, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.